If you've ever tried to scale a real estate portfolio, you know the drill. You hand over years of tax returns, endless pay stubs, and a mountain of W-2s, just hoping the bank approves you. Right now, the Florida real estate market is expanding rapidly, especially in places like Tampa Bay. Renters and vacationers are pouring in. But traditional lending models often disqualify highly profitable investments because the buyer's personal paycheck doesn't match a rigid bureaucratic template. This barrier hits specific groups the hardest: self-employed entrepreneurs, high net worth retirees, and aggressive investors often find that their personal income profile simply doesn't fit into the rigid boxes on a standard 1040 tax form. The reality is that traditional underwriting doesn't evaluate whether a property is actually a good investment. It only measures how well a human being complies with standard payroll administration. But there is a different way to secure funding. Instead of the bank asking if you can afford the mortgage, what if the physical property had to qualify itself? This is accomplished through a financial mechanism called a DSCR loan. DSCR stands for Debt Service Coverage Ratio. Lenders using this tool completely bypass your employment history and W-2s. They look strictly at the asset and its ability to generate enough rental income to pay for its own expenses. By removing your personal tax returns from the equation, real estate investing stops being a test of your personal tax strategy and becomes an exercise in autonomous asset performance. To understand how an asset acts as its own borrower, we have to look at the math lenders use to evaluate it. The first step is taking the traditional debt-to-income, or DTI metric, which compares your personal debt to your personal salary, and throwing it out. In its place, underwriters use the DSCR formula. They divide the property's gross rental income by its debt obligations. Those debt obligations include the property's expected monthly principal, interest, taxes, insurance, and any applicable HOA fees. To calculate the income side of the equation, lenders will use either the active lease currently on the property, or they'll pull a market rent estimate provided by an independent appraiser. Because they rely on these estimated market rates, the house doesn't even need a tenant in it when you close. A completely vacant property can secure a loan, provided the projected income numbers hold up. This style shows the primary threshold for a DSCR loan approval. When running this formula, lenders are looking for a specific target, 1.0. A ratio of 1.0 means the projected rental income exactly covers the monthly expenses. The property can pay for its own existence and break even without you injecting outside cash. While 1.0 is the standard minimum, some lenders will let that ratio dip as low as 0.75, provided the borrower has an exceptionally strong credit profile and the cash reserves to cover the shortfall. Hitting that 1.0 mark is the dividing line. It proves the building isn't a personal financial drain, but rather a self-sustaining asset that carries its own weight. Because this math isolates the property from your personal income, the traditional limits on how many properties you can own disappear. Your ability to scale a portfolio is no longer tied to your salary. Investors use this strategy to acquire standard residential real estate. Single-family homes, duplexes, and up to 4-unit buildings all fit the standard DSCR criteria. But there's also a highly lucrative alternative path. Where local ordinances allow, short-term rentals like Airbnbs are eligible for this exact same financing. That makes the DSCR loan incredibly effective in places like St. Pete and Tampa Bay, where tight housing supply collides with massive year-round tourist demand. By matching high-yield vacation properties with asset-based lending, investors can capitalize on Florida's heavy migration patterns to build a self-sustaining portfolio that compounds with every new acquisition. Of course, ignoring a borrower's income introduces risk for the bank. To offset that risk, these loans require strict baseline qualifications before you even sit at the closing table. First, underwriters demand skin in the game. You'll typically need a minimum credit score of 660 and a substantial down payment ranging from 20 to 25%. The flexibility also comes with a direct financial cost. DSCR loans almost always carry higher interest rates than conventional mortgages, and they frequently include rigid prepayment penalties if you try to sell or refinance too early. These premiums are simply the toll required to bypass the traditional lending gatekeepers. If you are ready to stop letting a W-2 dictate your investment ceiling, click the link below and run the DSCR numbers on your next deal.